Okay, so a very, very good morning and welcome to our market preview for the coming week. My name's Aaron Hill and I am the Chief Market Analyst based here at FP Markets. Now, after 43 long days in complete data darkness, traders are finally about to get their hands on real US economic data. But here's the thing, this isn't going to be your typical data week. We're dealing with stale September numbers, September jobs numbers, while October's figures may never see the light of day, according to the White House. But from what I understand, we will see the payrolls print for October, but we are very unlikely to see the unemployment print because that forms part of the household survey, which requires actually calling households for the data. So that creates a very unusual trading environment where the stakes are high, but the information is incomplete. Now, last week's price action was important. Markets are clearly nervous. We saw aggressive volatility, we saw sharp reversals, and we saw positioning that really didn't quite make sense if you believe that the simple narrative that fading rate cut expectations drove everything. As you will soon see, the dollar did weaken over the week, even as December cut odds collapsed from a whopping 70% to 40%. Gold also surged for most of the week despite those rate cut expectations. Look, guys, clearly something more complex is happening beneath the surface here. Now, the September jobs report was collected before the shutdown, but sat really essentially unprocessed for over a month. So this should be a relatively easy print to publish. Meanwhile, while the US government was in shutdown, we had US employment components and we had the ADP figures out and really painted a picture of a cooling labor demand. So consensus for the September print calls for 50,000 jobs to have been added over the month. This is up from 22,000 in August, but look at the estimate range here between 120,000 and minus 20,000. So it's quite an estimate range. Markets are clearly, or economists are clearly unsure here. With the unemployment rate, we are expected to remain at 4.3%, up from matching August's number, but we do have an estimate range between 4.5% and 4.2%. Now, the whisper number, what traders are actually, I believe, are positioning for, is likely closer to around to 30,000 or potentially even lower, given what we've learned from private sector data. Now, if we see a negative number, if we see something like 20,000 or 10,000, this would be the first negative payrolls print since around 2021, and I believe the first since the COVID pandemic era. So what does a negative print mean for the US dollar? Well, I believe it would mean dollar weakness. Now, let me just spin over to the dollar index chart. For me personally, I do believe a bearish play is still technically viable. Look at this monthly resistance at 99.67. We are clearly in the beginnings of a long-term downtrend with that lower low formed here. This is following the April Liberation Day tariffs that we pushed lower. So we are still consolidating between that channel support on the monthly time frame and that resistance level at 99.67. And as you can see, we are now moderately fading this level. Now, if we spin across to the daily time frame, you can see that price has been in the process of pulling back and forming what appears to be the beginnings of an uptrend with a series of higher highs and higher lows. But for me to be convinced, I would need to see price come above that 200-day simple moving average at 100.04 and this resistance at 100.54. As you can see, price did reverse just ahead of that 200-day simple moving average and has been to the downside since. So if we do get a negative print, I am expecting a pop lower to this support on the daily time frame at 98.58 and that 50-day simple moving average that merges with that support level there. In terms of a negative print, I'm also watching the euro dollar right now. For anyone that follows our analysis, you would note that we highlighted a particularly interesting support level between 1490. Sorry, not between 1490. It was 1490 on the daily time frame. This was an ideal area. As you can see, a demand here was building a lot of trust at this point here, and the stops below this area with this hidden Quasimodo resist support level was just ideally positioned to for a stop run below this demand. And adding to that, we also have the monthly support at 1457 backing up the level, providing a nice area to position stops below. Anyway, as you can see, we did react from this level, and we are now testing a support, sorry, a resistance at 1647, closely shadowed by another resistance at 1694 there. Now, if we do get a negative number, I would be looking at euro dollar upside, of course, but I would need to see price engulf this resistance at 1647 to have any conviction that we would move for this local resistance at 1694. So right now, nothing as of yet. I don't see any major support to work with. At current levels, I would need to see a break of that resistance should we get a negative number from the data this week. In terms of a strong beat, so if we see the non-farm payrolls print, say 70,000, 80,000, 90,000, then I would be looking at dollar strength, as this would effectively catch a lot of traders off guard, given positioning and the whisper number of around 30,000. So first and foremost, I would be looking at dollar strength, as I said. So the dollar index would be an interesting play. But right now, I don't see anything in terms of clear supports of, bolstering a dollar bid. Ultimately, as I said, I would want to see price engulf the 200-day simple moving average to convince me that, and its resistance, to convince me that the uptrend is something to take that's serious to the upside. And if we do get a break above this resistance, I will be looking at this resistance here at 101.92. So right now, other than this support level here at 98.58, this is the only support level I'll be watching. So if we get a spike lower to this level on the back of a strong beat in the jobs data, this would be an ideal area to begin looking for longs. But look, guys, I feel really uncomfortable entering long, knowing that we have this monthly resistance at 99.67 here. So trade this accordingly and always adopt a strong risk management approach to this to a strong beat in the data. We could also short the euro pound, but you could also short the euro pound based on the back of the reaction from this resistance. But again, the players, it's already played out, right? So we've already got a reaction. So I'd want to see price dig deeper into this resistance level, hunt for a lower time frame shorting opportunity before pulling the trigger. Switching over to the UK this week, we have UK inflation out on Wednesday at 7 a.m. This is a particularly interesting data print. You will recall that the Bank of England did hold rates unchanged at 4%, and it was a tie-breaking vote with, Governor Bailey cast the tie-breaking vote at the last meeting, but his commentary was clear. I believe he was veering or siding with the doves somewhat here, and he's looking for evidence of disinflation, which is why this print is all the more important. Now, in terms of rate cut expectations for the Bank of England right now, just bear with me. You can see that markets are pricing in around a 75% chance of a 25 basis point cut, or 19 basis points of easing priced in. So this is quite, this is almost fully priced in for a rate cut. Now the CPI, as I said, has outsized importance in my view because of what Governor Bailey. Essentially on Governor Bailey's comments. So as you can see here, the headline year-over-year print is expected to ease to 3.6%, down from 3.8%, We have a rather large estimate range here between a maximum of 3.9% and a lower estimate range of 3.2%. In terms of the core CPI year over year print, this is for October data, guys. So the core CPI down is expected to come in at 3.4%, a notch lower than the 3.5% in September. The estimate range between 3.6% and 3.2%. So it's quite a large range there. In terms of the services data, year over year, 4.6% expected, a notch lower than the 4.7% recorded in September. Estimate range, again, guys, quite wide here. 4.8% for a high, 4.4% for a low. But the crucial, really, the main point here is markets are already pricing in, essentially already pricing in a rate cut. So we would need a significant downside deviation, a downside print. So we'd need beyond, I believe we'd need beyond the minimum estimate range here, 3.2, 3.2 for both the core and the headline. So if we see core CPI come in below 3.2% and the headline below 3.2%, this, in my opinion, would remove any doubt that the Bank of England would cut rates on the 18th of December here. Look, I believe money markets would, 100%. This would be a nigh on 100% probability pricing this in. You would also see February rate cut odds jump to around 50, 60, probably even 70% on the back of that. But the point I do want to highlight is the autumn budget does hit very, very soon, and this could prove tricky, very tricky to navigate. Therefore, a dovish miss is not something I would personally look to hold medium term. So in terms of the trade for I'll be looking at the pound dollar here. I would be looking for price to engulf this support level at 31.29. As you can see, we are in a clear cut down trend. We have been since around the middle of September, series of lower lows and lower highs. We've just recently pulled back and we're testing this resistance between 32.46 and 32.05. As I said, if we do engulf this support at 31.29, I would be looking to test these lows of 30.54 and potentially engulf this level for this support down here at 129.09. Now, the rationale for pound weakness here would be, look, if we do get tax hikes as is expected from the autumn budget, plus inflation coming in much lower than expected, look, what reason does the BOE have to wait? They may as well cut rates. So this would be a negative for the pound. Now, let's assume that we do see a higher than expected print. So if we see UK core CPI come in around 3.6%, if we see the headline print come in around 3.9%, what does this mean? And look, I'm personally not that keen on entering long the pound right now. There's just so many considerations to take into account here. I do believe if we do come in at these levels here, 3.9 on the headline and 3.6 on the core, that this would trigger a short-term upside move in the pound. But would it be anything to get excited about? I don't think so. This is more of a scalp for me. Why do I believe this? It's pretty simple for me. Look, even if inflation does come in higher, look, growth is pretty dismal. We had the GDP data out recently and for Q3 and for September, and it was a pretty dismal. It came in lower than expected, and it barely showed any growth at all. And the budget, if we factor that in as well, the budget is likely to include measures that also weaken demand. So I'm not really keen on a pound long on the back of a higher than expected print. But if we do get a strong upside move, look for a break of this resistance here between 32.46 and 32.05. If we do get that, then technically there is a small area of resistance between this low here of 32.62 there. But overall, I don't see anything really stopping price from at least hitting this small decision point around the 33.35 level, closely shadowed by that resistance at 33.73 there. So we could see potential, a small pop to the upside here. But yes, not something I'm really looking to trade given the growth picture and the upcoming budget. Now, also we have flash PMIs on Friday. This is these are, this is what I'm looking at right now. What I'm looking at, how I'm looking at playing the PMIs this week is, look, European data. We all know that Europe has been showing surprising resilience, right? The UK hasn't, as I've just explained. Now, if we if we see if Eurozone PMIs beat expectations, so if the Eurozone PMIs, so the French, German, and Eurozone beat expectations, and the UK PMIs disappoint at 9:30, this is just a half hour after the Eurozone prints come out, then I do believe this could offer some euro pound upside that could be on the table. So if we quickly look at the euro pound chart, and this really goes, so for euro pound upside, this really feeds nicely into the clear cut uptrend we've seen on the euro pound since, for this year, let's be honest, for the entire year, we've seen the euro pound minus the rather deep correction here in April, May, we have seen the euro pound climb higher. So this could provide a dip buying opportunity, if you will. But look, technically, we have just come off of this resistance between 0.8875 and 0.8838. So do bear that in mind. Ultimately, I'd like to see price whipsaw below this support at 87.73 into this support level down here at about 87.50 before I would consider a trade here. So we've taken out any active stops below here and we've bounced off of this level. So traders would use that liquidity, them sell stops there, to buy into that move in line with the uptrend. Now, with the macro data out of the way, we also have Nvidia earnings on Wednesday. Now, I'm primarily an FX trader, so Nvidia, so equities is not really where I specialize. But look, Nvidia earnings have become it's a huge event. It's almost like the NFP now. So how I would look to play this is, look, Nvidia carries a huge weight in major US indexes. You only have to look at the index weighting classification for that. So this is certainly a market mover to be aware of. And it's also coming with implied volatility of around 7% in either direction. That is huge. So bullish factors supporting the Nvidia. Technically, look, we are in an uptrend and we have pulled back. This could be a potential dip buying opportunity. Technically, we also have that bullish piercing pattern on Friday. For anyone that's not aware of that, this is a bullish signal from a technical analyst's point of view. Now, other bullish factors, we have over 500 billion in orders from Blackwell until 2026. Look, I would be looking for AI infrastructure build out to continue as a bullish factor as well for Nvidia. Now, in terms of bearish factors for the stock, Michael Burry, however much emphasis you place on this, placed 1 million puts against the company. So I've read. SoftBank sold its entire stake. And look, there are clearly valuation concerns after the in recent in media. So look, technically, I'm still very bullish this stock, and we have recently rebounded from this support. I mean, almost to the point of 180.62, and we engulfed back above that support at 185.23. That was a huge move. That was 2% to the upside here. And look, we are now testing this resistance at 189.99. If we do come above this after forming that bullish piercing pattern, I don't see any reason technically that the stock won't continue up to that resistance of 207.98. And look, this is all-time highs, guys. So I would believe we will challenge those all-time highs. We may get a small pullback to the downside here, but overall, once we're in this area, I think we're off to the races to the upside with a break above here, potential retest, and a push to the upside. So to sum things up this week, we're entering a week where data will finally flow again, but the information is somewhat compromised. September numbers for the US employment report are stale. October numbers may never arrive, but the payrolls is likely to arrive without the unemployment print. The Fed, look, you've only got to look at the recent Fed commentary. It's essentially neutral to hawkish, I think it's around four members that are dovish, four members, I think, that are dovish right now. So the Fed remains genuinely uncertain about the economy's trajectory. Um, the jobs report, the US jobs report, really remains the week's anchor point. Everything revolves around whether the labor market is holding up or it's softening. So good luck, and let's see what the data tells us. Trade well and have a great week ahead.